Hi trader, this is Chris from Elite Currency with a new video on all angles of defining the trend, part 2. Before we dive into today's topic though, be aware of the following disclaimer. Trading for exchange and global financial markets is considered high risk, may not be suitable for everyone. Therefore, please seek the advice of an independent financial advisor for more information on that. This video and recording is for educational and informational purposes only, and by continuing watching this video, you agree with this disclaimer and you are aware of the risk involved when trading. All right, thank you so much for your attention. And if you haven't tried the MT4 Supreme Edition for Admiral Markets, take a look at it. Great extra features. So that's why we trade with Admiral Markets, Nenet, and myself. All right, let's take a look at today's topic. The trend, basically, how do we know there's a trend? And how do we understand whether the price is ranging or reversing or indeed trending? And of course, this is important so we know that we can match our strategy towards the market structure, what's going on. Now, moving averages are very important in understanding if there is a trend. It's, I think, one of the best tools for doing that. And with the help of moving averages, I can easily spot and identify by looking at the chart whether price is trending, reversing, or consolidating. And therefore can judge whether that particular pair and time frame is interesting for me to trade or not. Very simple. So how do I use those moving averages to make that decision? Well, obviously, when you see, for instance, this, you can see that price has been in a long downtrend. Your dollar here in October, November, moving nicely on this 4-hour chart to the downside. And one of the basic things is just having the moving averages aligned with price below it. Price is below the short-term moving average. The short-term is below the long-term moving average. And everything is neatly lined up. Right? You got here, if I may use this drawing tool, here you got the price, here you got the short-term, and here you have the long-term, nicely, of course, aligned with each other, giving that downtrend. Now, how does that look here? Well, obviously, price is in between the two moving averages, and they're not, it's no trend, it's a consolidation, right? Clearly, you can see that in this case. So, I think that just looking at these two sets of moving averages, a short and a long-term, already provides a ton of information about the trend when you look at it compared to price. Now, how would that look like if there is no trend? As you can see here in the purple box, that's of course clearly a zone where there is no trend. It's ranging, consolidating. And well, that's pretty simple, but why is it so? I use the rule that when basically the moving averages, the long and the short term, are on top of each other or touching each other, that basically a trend is not present. All right, so when a trend is present, the short term is moving away from the long term, or at least is not touching it. And obviously, if it's moving away from it, it's an impulse. So let me give you an example here on the left. You can see, for instance, here, the moving averages are not touching each other, but the short term is pointed to the downside. So there is a bit of a correction here. Then when price breaks above it, the moving averages keep that distance, but the short term has a bullish angle. That's, of course, where we have the most momentum, right? So that is a very interesting part. Now, obviously, in this zone, moving averages are on top of each other, and that's when we can say that price is in a consolidation. So that's my rule for that. Now, the spaces between the moving averages are important too, as I already indicated in the previous slide. If there's space between them, and the bigger the space, in fact, between these moving averages, the more momentum there is present on the chart. And when price has this momentum, it's able to push more. So the more momentum, the more it can actually move away from these averages, and that creates the gap. And of course, at one point or another, price will go back to the average. We will not be able to pull away from the moving averages forever. And that's why we have divergence eventually, and price then moves back to the averages. And that's something we'll discuss in next videos as well. But obviously, you can see that the more momentum, the easier it is for price to kind of break free from those averages. That's basically what is happening with those spaces. So let's talk about a bit concrete numbers. I know that a lot of traders are asking about that. Now, very honestly, I don't think that actually the numbers make that much of a difference. As far as I've read, studies have shown moving averages in general are very profitable. EMAs tend to be a bit better than SMAs, but all do very well. So I think that all of them really are great. The most important part probably is actually to acquire and build up that experience with a particular set of moving averages of your choice. It's not that good to bounce around using one for a few days and the next a few days, because you don't get that experience with that particular set of moving averages. Also, you have to note that whatever you choose, realize that moving averages are only, of course, a general zone, not a very precise number. They're always just a zone, and price could easily go 10, 20, 30 pips through a moving average before respecting that level. Always have to be aware of that. Now, for short-term moving averages, I tend to use the 21. I really enjoy using numbers that are based on Fibonacci sequence numbers, so that's why 21, which is one of those levels. And what I do is create 3 of them. As you can see here, there are 3, and they have about, they're actually kind of parallel to each other. And I call it the band. And they're basically the 21 EMA close, high, and 21 EMA low. Now, the reason why I like to use this band is because it basically provides me, indeed, that zone of support or resistance as a constant reminder to myself that it's just an area of interest, not necessarily one point. And yeah, it does a great job, I think, the 21, of capturing momentum. As you can see here, nicely price staying when it's really going fast. Price stays below that 21, it doesn't touch the 21, right? There's a price gap between basically the 21 here and price. All right. Now, the long-term moving averages I use are basically these purple lines. The purple ones are long-term, and they're 144 and 169 EMA close, which is referred to by traders as the tunnel. These numbers are also Fibonacci based, and basically price tends to respect these long-term very much so. Right? Price really likes to use it as a spot of either reversal, like you see at the top here, where price was breaking below it, and boom, and the moving averages too, the short-term below the long-term trend change, or as a point of trend continuation, as it basically goes back to the long-term as a reset for one more leg or 2 more legs to the downside. So those are my favorite, and as you can see here, when you use both, you get a very comprehensive understanding of the market, because you have 2 sets. I like using 2 sets. Some traders even use 3 sets. Some use 1. I like 2 because it doesn't crowd the chart too much, but you get a very good sense of the momentum and the long-term trend and the short-term trend here. And there's a good reading that what the trend is and whether there's a retracement or a range going on. All right, now there's one more thing I wanted to add. In fact, that's the momentum moving average. That could be anything from very, very small, from like a 3 EMA up to, for instance, a 13 EMA. I often use a 5 or 8, and that really shrugs and hugs price very closely, as you can see here. And really the only benefit of this, I think, in my opinion, is just the fact that it shows momentum. What kind of momentum is happening now, right? And if that has a bullish angle, it's probably a good momentum to the upside. If it's bearish, it's depending on the angle, of course, as well, but roughly gives a good idea about the momentum. As long as price stays above the 8, there's a strong up trend or up momentum. As long as price stays below it, now there's a good chance of a bearish momentum, especially if the angle is there as well. All right, so that's a good momentum moving average. All right, so if you're interested in opening an account with Admiral Markets, that's a great way to do that through us, because you get a moving average course that is included, valued at 890 euros. So all the things that we talked about and more, you can find out right here. And you get also a lot of credit as well. As you trade, the volume you trade, we give you credit to order and get products and indicators and systems and courses from us. So you gain as you trade, and you also get a course from us for 890 euros. Of course, Admiral Markets, a lot of great things included: great customer care, great analytics, great software. So there's a ton of reasons just to choose Admiral Markets as is, and if you choose to do that through us, you get some extra benefits as well. And if you're interested in HARP, that's our main system of trading. We have a special method of deciding the trend on HARP, and that is proprietary. We also use moving averages, by the way, but it's proprietary, cannot explain that. But for instance, Bob here, trading for already a couple of months, says it's very easy to use, reliable and robust, has 81% success rate so far, is very happy, and has made HARP his favorite trading strategy. So if you're interested in HARP, don't miss out on the €1,500 discount until January 4, and use the December special code, the voucher, and you can order here or take a look at the links for more information. Thanks again, and wish you good trading. Cheers.